Hey all, welcome back. This is Raj here. We are at ShareTreck, and today I want to talk about the big picture in the markets right now because things are at a crucial juncture in my opinion, so let's dive right in. The first thing I want to talk about is the fact that market valuations are quite high. Are we at a turning point? Right now, equity valuations are sitting near all-time highs. We have tested these levels a couple of times before, and next week could be the third attempt. And the big question is, do we break through or do we see a trend reversal? Historically, markets struggle at resistance level like this. Sometimes they break out, sometimes they pull back. So what's next? We'll explore that today. Shifting world order is the second topic on top of my mind. Uncertainty is there ahead. We're also seeing shifts on the global stage. For example, JD Vance's speech in Europe this weekend, and the reaction to it suggests that the world order as we know it is changing, and it's changing fast. The way countries interact, the alliances we have taken for granted, all of that is evolving. But what comes next? That's still unclear. And when the rules of the games are shifting, markets tend to react. I'll talk more about this as we proceed in the video. Ukraine war is coming to an end in my opinion. Could sanctions also end? Right? The Ukraine war, one way or the other, it may be reaching a turning point. If that happens, we have to consider whether it means what it means for the markets. Could Russian sanctions be lifted? If so, what does it do to commodities like oil and gas? How would currency markets react? These are big questions that investors need to keep an eye on. And then the other question is, what should retail investors do? Right? So what should we expect? Right now, uncertainty is high for retail investors. That means it's time to think strategically. Should you be more defensive? Should you look for opportunities in undervalued assets? We'll break that down. And finally, there is this case for hard assets, which is the central point to which I am going in this video. My conclusion is that hard assets are things that cannot be printed or easily produced, and they are worth considering. And the prime example would be gold, silver, and real estate. In times of uncertainties, these have historically held value. It's something every investor should be thinking about. That's what we are going to be talking today. Let me know in the comments what you think about these things. How are you positioning yourself in this market? Are you bullish or are you preparing for a shift? With that said, let's get started. Welcome back, friends. As you know, our channel is almost 3 years old now. When I started, I was a rookie content creator. Right now, I don't consider myself an expert, but my learning curve has been steep. Over the time, the channel has grown and I've made a lot of improvements along the way. This year, there's going to be a renewed focus on genomics, and I'm really excited about it. And to keep up with the markets, I'm now doing a daily pre-market live stream on weekdays at 7:45 a.m. Join me live. We'll go over the latest market moves, exchange intelligence in the market, and I'll also take requests to analyze any ticker you have in mind. So looking forward to see you there in my live sessions, 7:45 a.m. Every trading day. That said, let's dwell into the topic for today. Let's take a look at the indices. We see that the main indices are at or close to their peak all-time levels with strategic resistance ahead. So I'm going to get into trading view momentarily, and we'll go through the indices and then we'll come back to the main theme of our discussion. Let's start with our Dow Jones index. And out here you can see that we have broken above this bullish pennant that we had, or bull flag, or whatever you may decide to call it. And we are gone above past resistance, which happened to be at 6092.01. Now we need to retest that and then go back above. So when it attempts to retest, there's a possibility that it could drop down. We don't know what's going to happen out there. So that's one aspect that we have to keep our eye on. Therefore, I would say that at this point of time for retail investors, instead of trying to predict, we have to react to what happens in the market in the process. We may have less profits, but at least we'll save our capital. It will be a really horrible thing to get stuck holding assets at this level when the market starts dropping and a correction takes place. A correction would be overdue, and at this point of time, these feelings that we are at an all-time high and valuations are very much stretched and the end is near is likely to be compounded a lot, because we have this tendency to look at a narrow segment. But if you were to zoom out on S&P 500, I'm just going to recalibrate the chart. you would see that in the past also we have been to places where we thought it was the peak. Then we did a little bit of correction, consolidation, and right now we are at all-time highs. But this all-time high is also in future going to look like where we were on 3rd of January 2022, or maybe like where we were on 28th of July 2023, because then we'll consolidate, go down a little bit, and then go up again. So that's the way the markets react. And if you look at the continuum of the market from the day it started to now, I think you will see that's the only direction in which the market has gone has been up. And then if you look at IWM, again, IWM is also tackling a resistance out here at 226.63, and it's closed at 225.97. So it's still below it, and it needs to break through that resistance. And can it do that is a question. Next, we have the NASDAQ index, and in NASDAQ, you will see that we are at an all-time high out here. Let me draw a trend line out here. I'm going to expand this chart just so that you can see everything clearly. As you can see, we have a resistance out here. I'm going to just adjust the lines. So we have a resistance out here, which was the confluence of this diagonal line of the bull flag and the horizontal line of resistance, which marked the previous high. And we are exactly at that spot at this point of time. Are we going to be able to break it? Because we are testing it for the second time. MACD looks good. Momentum also is looking great. So if we break through that, then the next thing would be for it to test. It has to test this level. So it has to go up and then it has to come back down. It has to test this and then go up. That's the way an orderly movement will take place. However, it's also possible that instead of going up, it could probably break down and come down. That's again another possibility. So first of all, we need to break through this resistance. Will that happen next week when we open on Tuesday? We'll have to wait and see. But I would say that for a retail investor, wait, watch, and then react rather than trying to predict and getting committed before any movement happens. That said, US policies are always fluid. One day the market rallies, the next it drops based on new policy announcement by the Trump administration. This unpredictability makes it tough for retail investors and investors in general, but it also presents us opportunities if we know where to look. We may be approaching the end of the Ukraine war, and if that happens, we could see Russian sanctions being lifted. This could unleash a wave of liquidity with rebuilding efforts in Ukraine and Russia kickstarting economic activity. At the same time, Donald Trump has long wanted a Nobel Prize, just like Obama. His best shot at it is basically getting his buddy Putin or Netanyahu to help broker peace, either in Ukraine or the Middle East. And that's the basis of my speculation that Ukraine war must be coming to an end. Because when I look at the way the Middle East is looking, it doesn't seem like we have an easy solution out there. Even if Netanyahu was to cooperate, I don't see a solution. In case of Ukraine, Europe may take a different path. Instead of following the US, they could continue supporting Ukraine and keeping Russian sanctions in place. And if that happens, we might see other countries' sanctions lifted instead, leading to more oil and capital flowing into US, which could strengthen the dollar. Because for the sanctions to be effective, all the parties have to support it. Right now, when we talk about all the parties, the main other party is EU, which is the next biggest bloc, and Euro constitutes almost 20% of reserves in most of the global central banks. So Europe is the next biggest one, which helps US to impose the sanctions. So if Europe decides to diverge from US when it comes to the Russia-Ukraine issue, then US lifting sanctions from Russia would not necessarily mean that Europe is also going to lift the sanctions. And if that happens, then the oil trade between India and Russia, which was kind of an exception to the US-Europe unity to imposing sanctions, could then become the kind of norm that we would see. So the whole landscape might look different, and Europe in turn might lift sanctions on some entities that US has put sanctions on. So those kind of dynamics could happen, which again could strengthen the US dollar, because when currency gets liberated elsewhere in the world, it always flies back into the largest capital markets in the world, which is the United States, and the most safest assets in the world, which is the US treasuries. So that's what is likely to happen. And I'm thinking that reciprocal tariffs and trade realignments are a big opportunity. Let me explain. Okay, my take is that it's mostly a nothing burger when it comes to reciprocal tariffs. Governments may collect some extra revenue on both sides. When we talk about reciprocal tariffs, for example, let us say Canada imposes 2% tariff on eggs to US, and then US can impose 2% tariff on eggs from Canada. So it's kind of a wash when it comes to balance of trade, which is what Trump is looking for. He wants to prevent budget deficits, trade deficits. But at the same time, citizens on both sides are going to face an inflation of around 2%. So at some point of time, when countries have these reciprocal tariffs happening, both sides might eventually scale back those tariffs to avoid inflation, pushing us towards freer trade instead of more restriction, because later on we'll have a situation where both countries will start reducing tariffs on specific items on both sides, and those items will become cheaper, and also production will get adjusted between those two countries. Inefficient farms will move out in one country, efficient farms will move up in another country. Whatever might happen, there'll be equilibrium coming in over a period of time, and that will be the new normal with lower tariffs and a freer trade. Tariffs on Canada, Mexico, and China, I think, are a different story altogether. The way they have been proposed suggests that they could be delayed, watered down, or replaced with symbolic gestures. So that is going to continue to give the market a little bit of volatility. If that happens, Canada may start looking towards Mexico and EU and even China to reduce its dependence on the US. After all, the US already broke NAFTA once, renegotiated it, and could break it again under a second Trump administration, which is what this new tariff proposal is all about. So all of this points to new supply chains requirement for Canada, price realignments, and short-term disruptions. But over time, things could stabilize, and when it's all done, you would find that Mexico and Canada have developed more trade relationship outside of United States, and they'll be less dependent on United States. And that probably is what Donald Trump is also looking forward to. And around these kind of circumstances, my investment strategy as a retail investor is that this level of uncertainty makes me lean towards patience rather than chasing short-term profits. For now, my approach is more pre-market and post-market trades, riding uptrends with leveraged ETFs, avoiding short positions and focusing on covered calls for the downside protection, moving away from the speculative equities and focusing only on confirmed trend trading, and that to not holding for too long. I still hold long-term positions in Mag 6 stocks, having taken profits sometime earlier by selling half of the holdings, and then I have reloaded them back when the prices dropped. So right now, those positions are strong and green, and I plan to hold them for the longer term rather than add any more to them. And I think for the short term, I'm just going to be dealing with leveraged funds, that too for a very specific short period of time, and I'm going to make my cash flow through that. And in my long-term view, I'm looking at gold and crypto, and I'll be adding to gold and crypto and creating new positions in my portfolio. I've already bought IBIT, which is a crypto ETF, Bitcoin ETF. I would also be looking forward to add a little bit of Ethereum ETF, because Ethereum is beaten down and it's likely to go up. And gold, of course. Gold is not there in my portfolio in the stock market, but I have physical gold in terms of mint coins and gold biscuits. So they have appreciated significantly in value. So if we zoom out, the market always trends upward, as I explained before. And the reason is that innovation is always happening. Increasing productivity takes place due to R&D and better production methods and tools, and also expanding markets. But there is another reason also. The slow depreciation of fiat currency means that we are now paying more for the same thing. So if you look at a stock, the increase in the price of the stock is also partly because the value of the dollar is going down. The purchasing power of the dollar is going down. And therefore, the stock behaves more like a hard asset. And staying invested during such times means that you are able to preserve more of the value of your purchasing power as the fiat currency depreciates. So that's the reason why when you look at NASDAQ or S&P 500, they're always going up. I'm now paying more attention to gold and crypto assets that are outside the traditional financial system and can't be easily manipulated. This year, my focus is shifting. I'm keeping an eye on macro trends, geopolitical shifts, and the long-term implication of policy change. And let me know in comments what you think. How are you positioning yourself in this market? I would like to have that discussion with you in the comment section. Now, I want to specifically focus on why I have chosen gold as a hard asset that I want to be in. Gold has historically been a strong reserve currency for several reasons. First is the intrinsic value. Unlike fiat currencies, gold has inherent worth due to its scarcity, durability, and demand in various industries, including jewelry, electronics, space tech, etc. The other thing is that it's limited supply. It's not easy to manufacture gold. You have to have the gold mines operational, getting them permitted, getting them started, and then refining the gold, bringing it to market. It's all a long-term project. It's not that easy. New gold mines are not coming up that frequently, and the ones that are already in place are now reaching stages where the ore is not as easy to convert to gold as before. The density of the ore is less. So cost per ounce of gold in manufacturing is also going up, and all of this makes gold resistant to inflation and devaluation. This other aspect is that historically, gold has had universal acceptance. Gold is globally recognized and valued, making it a stable medium for international trade and reserves. And there has also been throughout history the evidence that gold has maintained its purchasing power even during economic crisis, making it a reliable store of value. I'll talk about this, and I'll show you some spreadsheets that I have made to demonstrate this particular concept. And also, gold has proven to be a hedge against inflation and currency depreciation in the long run. When paper currencies lose value due to inflation, excessive note printing, or if there is a geopolitical instability, gold tends to retain or increase its worth. And in case of gold, there is no counterparty risk. Let me explain what counterparty risk is. When I take a US dollar from you for the services that I have rendered, the US dollar is basically the promise by the US government to deliver me the value for a dollar. So if the United States government has given me a promise, the paper is just a promise. So the risk is that whether the US government will actually be able to meet that promise. So when the general environment starts doubting a country's ability to meet its promise in the fiat currency, then the fiat currency value goes down. That is the counterparty risk we are talking about. In case of gold, there is no counterparty. You pay the money, you get the physical gold, and it's in your vault. And that's the place where I would make a distinction between physical gold in your vault, in your home, as compared to paper gold, where you have an ETF. In that case, what happens is there's a custodian who is holding the physical gold, and there's another company which is giving you a paper asset where it earmarks a portion of that gold for you, and for that it takes a particular value, and that's the value of the gold ETF, right? So in that case, there's a counterparty risk. The custodian is the counterparty risk. If something happens at the custodian, then you lose the gold, right? So that's the concept of counterparty risk. When you have physical gold in your hand, there is no counterparty. So the solvency or insolvency of somebody else is not going to affect the value of your asset. And that reduces the default risk for you. And then you also have central banks. Holding gold helps central banks reduce reliance on any single fiat currency, providing financial security in times of crisis. If you look at the price chart that I'm going to show you for gold, it goes up, stabilizes, and then moves down again. I'm going to show that to you in the TradingView platform, and I'll talk about that to you. Here we have a chart of gold per ounce, and the symbol is GOLD, CFDs. And I have taken as much data as that is available. And if you see that on 1st of April 1968, gold was at $37.95. And when you look at US Federal Reserve in Fort Knox, the gold that they have, it's been valued at somewhere around $42 an ounce. Gold price has been steadily going up over the years. And there may be moments when it comes down, consolidates, and then goes back up, consolidates and goes back up. Those things happen when either productivity goes up and the value of the fiat currency improves, its purchasing power improves, then you see there is a little bit of a decline. And the period of time when there is world peace and globally everything is going well and there is an equilibrium and everything is fine, you find consolidation happening. And then when you start seeing inflation coming in, geopolitical risks coming in, you see a spurt upward. And then again, there is stability. And then we move up further. So this is the way in which gold behaves. And over the long run, it has always managed to hold value. One big drawback for gold is portability. Due to its weight and security risks, storage also needs security. And even if you keep it at home, you need security for your house. So as a result of that, we now have ETFs that hold gold and provide paper ownership. This also is now likely to become suspect, as recently the London gold market took 8 weeks to deliver physical gold that was supposed to be delivered T+1 day. So the next day itself, they were supposed to get the gold next day of settlement, but instead they got it after 8 weeks. And recently, JP Morgan is reported to have shipped $4 billion worth of physical gold from London to US. And many people are saying that this has happened basically because there's a price difference between London and US, and it's beneficial to take it to US. But I'm thinking, who would be owning $4 billion worth of physical gold? It would not be a single individual. Probably it's going into the Federal Reserve or some other place. So that's something that I'm not yet clear about, the exact reason why these things are happening of late, because they have not happened before. And if you were to look at Basel III norms, physical gold is considered a tier 1 asset under the Basel III banking framework. This means that banks can count gold as part of their core capital reserves. The rise in the gold price of late is also because many central banks are buying gold. And I'm going to show you a chart which shows the gold reserves. And you can see that it's increasing by country. Here is the chart that I'm looking at. This is the gold.org website. It shows 2024 gold reserves in US dollars millions. If you look at the spread out here, you can see that the United States has got the largest increase in gold as of 2024, followed by Germany, China, Italy, and France. And then we have the small drop-down table here, which can expand to a list of around 130 odd countries. And they keep on buying. The buying activity is increased of late. Next, I also want to discuss about the stealth depreciation of US dollars. Here I have a spreadsheet. If you can see in this spreadsheet, what I have done is I have taken average prices of some key indicators in 1990. I have taken the price of gold in ounces in 1990 and divided it by that. And then I have taken the average price of those key indicators in 2024, divided them by the price of gold ounces in 2025. So what I'm trying to do is to see how much could an ounce of gold buy in 1990 and how many ounces of gold you need to buy the same thing in 2025. If in 2025 you need less ounces of gold to buy the same thing, that means gold has retained value and the dollar has lost value and other assets have lost value. So that's the way we will see. And in case of some assets, it could be depreciation of the assets themselves. So first of all, I have here gold. It was $382 per ounce in 1990. Right now it is $2,386 when you look at 2024 prices. And if you look at the market right now, we are very close to $3,000. That's almost $600 more than where we were in 2024. Now, if you look at the price of an average house in 1990 in the US, it was $125,000, which now in 2024 became $419,000. And when a layperson looks at it, they say house has become very expensive. But if you look at it in price of house in terms of gold ounces, you would need 327 ounces of gold to buy an average house in 1990. And right now you need only 175 ounces of gold to buy the same house. So if you have been holding gold since 1990, the purchasing power of your gold has remained steady while the fiat currency has dropped in value. So that's the way I would look at this. Consumer price index was 130 in 1990. If you convert it into gold ounces of that time, it was 0.34 ounces is what it was. Right now, it is 0.13 ounce. So actually, we have not had inflation. In fact, gold has increased its purchase power. That's what it would look like here. But if you were to look at dollar terms, CPI was 130 in 1990 and 2024 CPI was 315. We'll say, oh, the CPI has gone up. Actually, what we are seeing here is a depreciation of the dollar, and the gold ounce shows that the price has actually gone down. The consumer price has actually gone down. But the fact that you need more dollars to buy the same thing means that the dollar doesn't have the same value in 2024 as it used to have in 1990. But gold has the same value and it has retained the purchasing power. If you look at a new car, an average new car in 1990 in the United States would have costed $15,000 approximately, which is now $47,542 for an average car in the US, a brand new car in 2024. In ounce terms, you would have needed 39.38 ounces of gold to buy a new car in 1990. Right now, you need only 19.93 ounce. And look at the cars that we get these days. They have such fantastic safety features, fancy features, advanced technology, music, surround sound, Apple Music, so on and so forth. All those things are there, navigation. Those things were not there in the cars of 1990. But they were still expensive when you look at it from a gold ounce perspective. They have become cheaper, higher technology, better car for a much cheaper price. So it's not actually inflation. But if you look at the dollar cost, new car, average new price of a car in 1990 was $15,000. Average price of a new car in 2024 is $47,542. The ordinary man says, oh God, it's expensive. In my parents' time, it was very cheap. So this is a difference, right? This clearly indicates fiat currency is losing value. Average wage of a US worker in 1990 was $21,027, and in 2024 the same is around $62,027. And if you look at it in gold ounces, in 1990s gold price, you would say that the average wage was 55.05 ounce in 1990, and in gold ounces right now it's only 26 ounce. So gold has retained its value, and if you had kept gold with you, I think you would need very little part of your gold to buy whatever you need to do. So as a retiree, I am thinking that I should have good amount of gold, because regardless of the inflation, I would still get money. And again, real estate is also likely to behave really good, but not as good as gold. And I'll explain why. If you look at this article about JP Morgan on Reuters, which is a reputed news organization, it says JP Morgan to pay $920 million for manipulating precious metals treasury market. So any of you, if you want, you can always Google JP Morgan $920 million fine, and you'll be able to find this article. You can read it in entirety, but for me, what it indicates to me as a retail investor is that it is possible that if there is 1 ounce with a custodian, that ounce could be sold to more than one person on paper. Unless all of them demand for the ounce at the same time in actual gold, that thing is not going to come out, right? I'm not saying JP Morgan did that. I don't know exactly why they were paying the fine. But what I am saying is that anybody who's got gold in their custody, what is to prevent them from issuing multiple letters of ownership for the same piece of gold to many people, right? So one of the other things that was happening with the London bullion market also, where instead of delivering physical gold on T+1, they took 8 weeks. So there was rumor mongering also that the bank had given it off to somewhere else, and they were scrambling to collect all the gold that was needed to be delivered. And that's what took them 8 weeks. There are experts in the field of gold who talk about it and who opine that what happens basically is that many countries would give their gold to a custodian to keep it safely for them in high security so that it can be picked up at a later date when required. So such custodians are supposed to have given it on lease to certain parties who in turn would have sold it to somebody else, and the lease would be for a period of 1 year or 5 years. And at the end of the lease, they would have made revenue selling that gold. And when the time came for closing it, they would renew the lease for another 5-year period. And the difference between the money they pay for the lease and the money that they collect by selling that gold is their profit margin. I do not understand this completely as a retail investor, but I'll be digging into this area more and come back to you with a more articulate explanation of what's happening. But suffice to say that a single ounce of gold is probably being amplified into multiple ounces of gold through paper ownership to multiple people. And I think that is in the process of unraveling, and that could also be behind pushing the gold prices up. And right now there is also talk going on that the US has huge deficits and new long duration bonds may not get as much uptake as it should, which means the yields will start going up. So in order to prevent that thing, probably US bond backed by gold might be in the offing. And another rumor is that gold stored in Fort Knox at $42 per ounce may be revalued to the market value or above, thereby increasing the balance sheet size and the power of the assets of the Federal Reserve, which can also lead to them being able to pay off a good portion of the debt. So those are the talks that I'm hearing. I do not know which one is which. This needs a little bit of investigation, but it is suffice to say that at this point of time, I'm more inclined towards buying a little bit of physical gold to supplement what I already have. Ideally, it is said that 5% of your portfolio should be gold. For a retail investor, it is difficult because there is this market in gold where if you want to go and buy an ounce of gold, you typically end up paying a premium of $140. And it is reasonable because the guy who is selling you the gold has got to store it, has got to keep his capital locked, and they are definitely going to charge for that. And that would be this premium of $104. And when you buy bullion, you have to buy a proper bullion biscuit with the serial number and certificate of authenticity. You should not buy a open package. It should be a sealed package with the serial number, PAMP, Welcome B, or Canada Mint. These are all reputed ones. And you just do not open the packet. You always keep it safe along with its certificate of authenticity and purchase price, put it all together into your locker, forget about it, right? So that's the way you got to do. Don't buy gold which is not certified, because when you go to sell it back, you might probably lose value, and you may also discover that it was not 99.9% pure. So certified gold and from a right source is the first important aspect that you have to keep in mind when you buy physical gold. The second thing you have to keep in mind is that the way you paid a premium while buying the gold, when you go to sell the gold, you are going to pay a premium to sell the gold, which means that you will be selling below the spot price, and that would be maybe $100, $120 below the spot price, provided you have not opened the packet, the certificate is intact, and the serial number is intact, and there is no reason for the buying merchant to suspect the authenticity of the coin. So you have to be very careful how you handle it and how you store it. That's most important. And if you manage to do that, then I think your long-term assets are protected, and the gold will retain value, and you can use it when you are retired or to pass on an inheritance. So that's basically what I'm thinking. I'm going to add a little bit of gold. I'm going to also add, I already have IBIT a little bit. I'm going to add a little bit of Ethereum ETF and put some Ethereum into my portfolio. So that's what I'm thinking. XXX leveraged for morning trades, pre-market and post-market, quick entry and quick exit, and keeping the long-term holdings intact, not adding to it any further, and then adding a little bit of gold and crypto to my portfolio through ETF, gold, physical gold, and crypto through ETF. That's my plan. And friends, I want to hear from you what you guys are thinking about, and what you plan to do in your portfolio. Is it still looking good? We are almost to the end of the second month of this year. What is your portfolio looking like? Mine is looking pretty bad, except for my long-term holdings. Everything else is looking bad, but I'm thinking that in the long run, things are going to be much better because of all the factors that I mentioned to you. And before I go, I would like to remind you that we have a pre-market live stream on every trading day at 7:45 a.m. Eastern Time. Please join me. We can have a lively discussion. I can do the analysis real time for you in the pre-market charts. And I can also take your individual request for any ticker to be analyzed. And with that, my friends, I'd like to bring this video to an end. Thanks and have a great day. Bye for now.